The topic I'm going to discuss right away now by venture capital firms and funds. What is venture capital structure? Venture capital firms, they are typically structured as partnerships, the general partners of which serve as the managers of the firm, and they serve as investment advisors to the venture capital funds raised. Venture capital firms in the United States may also be structured as limited liability companies, in which case the firm's managers are known as managing members. Investors in venture capital funds are known as limited partners. This constituency comprises both high net worth individuals and institutions with large amount of available capital, such as state and private pension funds, university, finance, endowments, foundations, insurance companies, and pooled investment vehicles called fund of funds or mutual funds. Now, type of venture capital firms. Depending on our business, the venture capital firms will be different. For instance, if you are an internet startup company, funding required from more manufacturing focused firm will not be effective. So doing some initial research on which firm to approach will save time and effort. When approaching the venture capital firm, it must consider their portfolio, business cycle. Do they invest in budding or established business? Now, industry. What is their industry focus? Investment. Is their typical investment sufficient for your needs? Location. Are they regional, national, or international? Return. What is their expected rate of return on investment? Involvement. What is their involvement level? Targeting specific types of firms will yield the best result when seeking venture capital financing. There are lists of venture capital firms that can help you for initial exploration. Now, National Venture Capital Association segment dozens of venture capital firms into way that might assist you in the research. It is important to note that many venture capital firms have diverse portfolios with a range of clients. If this is the case, finding gap in their portfolio is one strategy that might succeed. Role within venture capital firms. Within a venture capital industry, a general partner and other investment professionals of venture capital firm are often referred as venture capitalists. Now, typical career background vary, but broadly speaking, venture capitalists come from either an operational or financial background. Venture capitalists with operational background tend to be former funders or executives of companies similar to those which the partners finances or will have served as management consultants. Venture capitalists with finance background tend to have investment banking or other corporate finance experience. Although the titles are entirely uniform from firm to firm, other positions at venture capital firm include venture partners. They are expected to source potential investment opportunities and typically are compensated only for those deals in which they are involved. Entrepreneur in residence. They are experts in a particular domain and perform due diligence on potential deals. They are engaged in venture capital firms temporarily, 6 to 18 months, and are expected to develop and pitch startup ideas to their host firm, although neither party is bound to work with each other. Now they move on to executive positions within the portfolio company. Principal. It is the mid-level investment professional position and often considered as partner track position. Principal will have been promoted from a senior associate position and who have commensurate experience in another field such as investment banking or merchant consulting. Associate. It's a typically most junior apprentice position within venture capital firm. After a few successful years, an associate may move up to senior associate position and potentially a principal and beyond. Associates will have worked for 1 or 2 years in another field such as investment banking or management consulting. Now, structure of the funds. Most of the venture capital funds have a fixed life of 10 years, with the possibility of few years of extension to allow for private companies still seeking liquidity. The life cycle for most funds is generally 3 to 5 years, after which the focus is managing and making follow-on investment in an existing portfolio. This model was pioneered by successful funds in Silicon Valley through the 1980s to invest in technological trends broadly, but only during that period of ascendance and to cut exposure to management and marketing risks and any individual firm or its product. In such a fund, the investors have a fixed commitment to the fund that initially unfunded and subsequently called down by the venture capital fund over a time as the fund makes its investment. There are substantial penalties for a limited partner or an investor that fails to participate in a capital call. It can also anyway from month or so to several years for venture capitalists to raise money from limited partners for their fund. At that time, when all the money from limited partners has been raised, the fund is said to be closed and the 10-year lifetime begins. Some funds have partial closes when one half of the fund has been raised. Vintage year generally refers to the year which the fund was closed and may serve as a means to stratify venture capital fund for comparison. This free database of venture capital fund shows the difference between the venture capital fund and management company and venture capital fund and managed by the company. Now, what is compensation? Venture capitalists get compensation through a combination of management fee and carried interest. 2 to 20 arrangement, that is management fee, annual payment made by the investor to the fund or funds manager to pay for the private equity firm investment operations. In a typical venture capital fund, the general partner receives annual management fee equal to 2% of the committed capital. Carried interest is a share of profits of the fund, typically 20% paid to the private equity fund management company as a performance incentive. The remaining 80% of the profits are paid to the fund's investors. Strong limited partner interest in top tier venture capital has led to a general trend towards terms more favorable to the venture partnership, and certain groups are able to command carried interest 25 to 30% of their funds. The fund may run out of capital prior to the end of the life, so larger venture capital firms usually have several overlapping funds at the same time. This led larger firms to keep specialists in all stages of the development firms, almost constantly engaged. Smaller firms tend to thrive or fail with their initial industry contract. By the time the fund cashes out, the entirely new generation of technology and people ascending from the general partner may not know well, and it is prudent to reassess, shift industries or personnel rather than attempt to simplify invest more in the industry or people the partners already know. Venture capital funding. It is typically to invest in As a rule of thumb, the fund may be invested in one of 400 opportunities presented to it. Funds are most interested in ventures with exceptionally high growth potential. Only such opportunities is likely to be capable of providing financial returns and successfully exit event within the required lifetime. The venture capitalists expect, because of the investments are illiquid and require 3 to 7 years to harvest, venture capitalists are expected to carry out a detailed due diligence prior to investment. Venture capitalists are also expected to nurture the companies in which they invest in order to increase the likelihood of reaching an IPO stage when valuations are favorable. Venture capitalists typically assist 4 stages in the company's development: idea generation, startup, ramp up, exit. So there are typically 6 stages of financing in venture capital, roughly correspond to these stages of the company's development. First of all, seed money, a low level of financing needed to prove the new idea. Angel investors. Now startup, early stage firms that need funding for expenses associated with marketing and product development. First round, early sales and manufacturing fund. Second round, working capital for early stage companies that are selling product but not earning profit. Third round are called mezzanine financing, expansion money for newly profitable company. Fourth round, they are called bridge financing, intended to going public process. There are no public exchanges listing their securities. So private companies meet venture capital firms or other private equity investors in several ways, including warm referrals from the investors' trusted sources and other business contracts. Investors' conferences and symposia are summits where companies pitch directly to investor groups and face-to-face meetings, including a variant known as speed venturing, which is akin to speed dating for capital, where the investor decides within 10 minutes whether he or she wants to follow a meeting. This needs a high returns and make a venture funding an expensive capital source of companies, most suitable for businesses having large upfront capital requirements, which cannot be financed by cheaper alternatives such as debt. That is most commonly the case for intangible assets such as software, other intellectual properties whose value is unproven. In turn, this explains why venture capital is most prevalent in the fast-growing technology and life sciences or biotechnological fields. If a company does have the qualities of venture capitalists seek, including a solid business plan, a good management team, investment and passion from the founders, a good potential to exit the investment before the end of their funding cycle, so the target minimum returns is excess of 40% per year, so it will find easier to raise venture capital. Thank you.